Good evening. My name's Josh Van Gestel, and it is my pleasure to welcome you to this Retirement Essentials broadcast. I'm the National Education Manager for Australian Retirement Trust, and over the next 4 weeks, you'll be guided towards and through and well into your retirement with me and some wonderful, wonderful colleagues. We should, though, take a moment before I get into tonight's session to just reflect on what we're going to be talking about, especially in a week with a lot of geopolitics, a lot of headlines around superannuation with legislation announcements, but also the complication of continued market uncertainty and volatility, as well as the uncertainty that you yourself may have in thinking about your own retirement. These are all topics that we will look to explore over the coming 4 weeks, and I'm really excited about the journey that will be going on. Tonight's session, the first in this series, will be a bit of an overview and a taster of what will follow over the other 3 weeks. And I'm going to have Megan Ashenden, one of our education leads at Australian Retirement Trust, joining me a little later to go through this first topic that we'll be covering tonight. Before I do get into tonight's session though, I'd like to start by making a few acknowledgements. And firstly, I'd like to make an acknowledgement to the traditional custodians of the lands of Australia.
At Australian Retirement Trust, we're here for all Australians, today and every day throughout your working lives in retirement. We acknowledge that we work and live on the lands that have been cared for by Aboriginal and Torres Strait Islander people for over 65,000 years. At Australian Retirement Trust, our communities span far and wide, from Yanjin and Warren in the east to Boorloo in the west, to Naarm and Lutruwita in the south, and as far north as Zenith Cass. As we gather today, we acknowledge the traditional custodians of these lands and waters and their continuing connection to country and community. We pay our respects to elders past and present and to all Aboriginal and Torres Strait Islander people. We recognise the diverse cultures, laws and elders across Australia. We strive to listen and learn from this legacy to help create a better future for all generations, no matter where you are or where you're from.
The second acknowledgement I'd like to make is that tonight's content is of a general advice nature only. We'll talk to you shortly about some of the options you'll have to take out further information or seek further guidance, but we encourage you to remember that tonight, including any questions that we may be responding to, that you consider those and how they may apply to your own circumstances and consider seeking more formal advice before you take any action. The third acknowledgement that I'd also like to make is to all of you, to welcome you to taking a part in this series and in giving up your own time to actually invest in your own retirement. So the first thing that we'd like to really explore in tonight's session is what your retirement may in fact look like. And what we know from many is that they have great uncertainty around how their retirement may look and feel, the income they need, and whether it will be enough for them. We know that our members and the public at large actually also have uncertainty about how investments will play a part in their retirement and the considerations that they'll need to make. So what I'd like to do in the first few minutes of tonight's webinar is to talk to you about some of the unique considerations that you should think about in terms of your own retirement. The first is to consider when you may in fact be wanting to retire if you haven't already. And I know that the wish for many of us, including myself, is to retire perhaps as soon as we possibly can. But the reality is that we know retirement will come for most of us actually later in life, into our 60s and 70s. And that when we see early retirement occur, usually that doesn't come about because of our own choice, but rather it comes about because of circumstance. Illness that we ourselves may be experiencing, illness of a partner or loved one or our parents, that mean that we decide to step back or cease employment. It may also be as a result of a change in our employment itself. That means that we actually have to consider early retirement. So really think about when you would like to retire, but also remember that the earlier you retire, the more you will need in retirement funding. The other consideration here, and this is something that we will explore at time to time over coming weeks, is that we see many people who are in a partnership, in a relationship, who are part of a couple, that they will both often retire at the same time. That means that the younger person in that couple will often be retiring sooner, and again, there will need to be considerations around them having additional funding to look after them in that longer retirement. You think about that starting point as to when you would like to retire, and then the other consideration at the other extreme of that is when you think that retirement may end. What will be your life expectancy or your own expectancy on how long you think you may live. Australia is amongst one of the longest living populations in the developed world. We know that women will generally live to their mid-80s, and for men it will be in their early 80s. But think about your own situation, your own family history, your own circumstances, and how this may actually play out for you. In my own case, I've got a father who is about to turn 92, a mother who will soon turn 91, and I've also got aunties who are well into their century or getting very close. So I should assume in my case that if I actually behave myself and if I get through life healthy and well and without doing anything stupid, that I will live a very long life, and probably one that is far beyond life expectancy. So in my case, I have to make sure that I'm funding for that I'm funding not just from the point of retirement until life expectancy, but actually assuming I'll have to look after myself for many years after that. So in thinking about when you want to retire, how long that retirement may last for, the third thing that you need to consider is what will your retirement itself look like? What is unique for you and your retirement that is different than anyone else? And there's actually 3 ways that you can consider this. The first is to think about your situation. Reflecting on something I said a few minutes ago. Are you single or are you part of a couple? If you are single, you're going to have to carry the burden of expenses, like everyday expenses, yourself. But if you're part of a couple, those are expenses that you'll share. So collectively, it is actually cheaper for you than as it would be for 2 separate individuals. But also in terms of your situation, consider your health. Are you going to have to, in retirement, really look after your physical self, or are there injuries, ailments, or other issues that you are taking into retirement with you? We're also seeing now that many people go into retirement with children who are still dependent, as well as with significant debt, including mortgages on the family home. These are all things that will be unique to you and your situation, but they are important that you consider them, as they're going to be crucial in you working out how much you will need for retirement. Then think about your needs. These are the things that you will have to pay for day to day, week to week, month to month, just to get by. groceries, electricity, other utilities, the expenses that you know will come up and that you have to fund for. What we want to think about in terms of your superannuation over the coming weeks, as well in thinking about things like the age pension and other sources of income in retirement, which we'll talk about shortly, is how you can use that to not just fund those needs, but to also fund your wants. What is it that you want to do in retirement? You've paid for the things that you need to pay for, but now what are the things that you want to pay to enjoy? That is really where your superannuation lets you go beyond being dependent upon the age pension or being controlled in retirement by your needs. We're talking over the next few weeks about how you can increase that independence in retirement, increase that freedom, that enjoyment, and really enjoy those wants. To start to unpack this, I'm going to, in a moment, hand over to Megan Ashenden, who is going to help us tonight as a key subject matter expert and as someone who speaks to thousands of members a year in unpacking how much you may actually need for retirement. But before we do that, I'd like to just cut to a very brief commercial so we can take a very quick break.
Hey, Sue!
Bev, you're sitting on a monster.
Literally and figuratively. It's my superannuation from Australian Retirement Trust.
Australian Retirement Trust. Right.
Big, isn't it? Comes with an app.
I gotta get me one of those.
One day, I'll unleash it on the world, maybe even Barbados. Barbados, baby!
Awaken your super with Australian Retirement Trust.
Thank you so much for that introduction, Josh. And it is a pleasure to be with you in the studio tonight. And I'm really excited to walk you through some of the thought processes and concepts in really starting off the planning of your retirement journey. So as Josh has introduced, my name is Megan. I have been, just this week actually, it marks my 14-year anniversary with what is now Australian Retirement Trust. And I did start off on the Q-Super side of things, dealing predominantly with our government, Queensland government employees 14 years ago. So my job is to talk to members every single day and really to translate the ins and outs of superannuation and to put it into plain English so that we all understand it better, but more importantly, can go forward and set strategies and make changes to our arrangements to really build our super for retirement. And so I'm going to talk you through some of those considerations in just a moment, but just a little bit of housekeeping before we begin. So as Josh mentioned, this is the first of 4 sessions that we will be running on Wednesday evenings over the next 4 weeks. So this session is obviously really starting off the journey of how to plan for your retirement. Next Wednesday, we will dive more in detail around contributions with a much deeper dive in the how to grow your super session. The following week is looking at how to pay yourself in retirement the income that you'll need to continue to pay the bills, those wants and those needs that Josh has mentioned. And then finally, to finish things up, for our members that are already in retirement, it is a session looking about how to thrive and enjoy your hard-earned retirement years. So there are 4 sessions, and we encourage you to register for those that resonate with you, whether or not it's one, a couple, maybe all 4. The sessions are recorded, so you will receive those recordings post-event. And they are live sessions. We have a team in the background that are there waiting for your questions. So please submit them through those channels, and we'll have a team in the background that will respond to as many of those as we possibly can in writing. And then Josh and I are actually going to break for questions throughout, and we'll address some of the more pertinent, resonant ones with the audience as well. And last but not least, Upon registration, you would have received the link to the e-workbook, and you will notice icons on some of the slides as we go through the content that will actually link to the relevant page. There'll be some exercises and further information to support the information that we are presenting tonight. So with that all out of the way, we are leading up to the $1 million question. And honestly, if I had $1 for every time I am asked, how much do I need to retire? Do I need $1 million? When can I afford to retire? How long will it last? Honestly, they're all just variations of the same thing. And the fact is that there is no right or wrong answer. There are so many elements that will need to be considered in determining the answer that is right for you. And so that's really what we want to start working you through. But it will very much depend on, at what age will you retire? How long will you be retired for? How much income will you need to receive, and where will that income come from, super, non-super sources, to pay the bills, to keep the lights on, but also to do the fun, exciting travel, etc. in retirement. So there are, a lot of elements, and they are all building, the building blocks of your individual plan and what you need to do to get to that and to be on track to achieve that. So with that being said, I really do want to start with the concept of what's your number? What is the annual income retirement that you're going to need to be able to keep the lights on, to pay the bills, and hopefully also have enough in your bank account for the leisure activities and the travel, and really to be able to enjoy, the retirement that you have worked so hard to support. And again, there is no right or wrong answer. There's no, one-size-fits-all formula. But what I would like to walk you through here are a few guides that may be helpful in you planning this out for yourself. So firstly, the 2/3 rule. So a lot of financial advisors will sort of advise that 2/3 of your pre-retirement income is a reasonably rough rule of thumb of your income needs in retirement. And that accounts for not only the lifestyle that you would have been on in terms of your pre-retirement salary, but also accounts for things like the tax efficiencies of superannuation. And it is assuming that some major expenses, i.e. mortgage, are hopefully no longer a concern in your retirement years. Of course, that's not always going to be the case for every single one of us. So the 2/3 rule, obviously, if you are so inclined and you are a spreadsheet guru, you might do your own budget. And I know some people do this really well and others not so much. But if you know what life costs you and you are realistic in that budget, that is probably the most, the best or the most realistic outcome in terms of what your budget will be. You will need to consider not only those fixed everyday expenses, but also those wants as well as your needs. Then we can look at things like the ASFA retirement standard, which we'll run you through in a moment. And this is basically, real life retirees and what their lifestyle is costing them in today's dollars. And then, of course, using the retirement calculators that Australian Retirement Trust has on their website. And that's going to give you a good idea of a realistic figure of how you're tracking towards, how much super you will end up with and how long that will pay you an income for. So if we go to this ASFA retirement standard, as well as things like the age pension, and I'm very conscious of the fact that we are all individuals. We've got different working experiences. We've worked for different employers, different super balances. Some of us may have investments and assets outside of superannuation. Others, it might just be super. So there is always, in retirement, it is likely that your overall income may come from multiple sources. Super will be the focus of this because, of course, we are a super fund and that's what we're all about. But there is the age pension as well as non-super assets or incomes that people may also be utilising in retirement. So if we start by looking at, a budget, the budget in terms of your spending needs or requirements in retirement, we are looking here at the age pension figures. And of course, age pension do have age requirements as well as assets and income tests, which we will talk a little to in tonight's session, and we'll go into more detail in our How to Pay Yourself session in a few weeks' time. But really this is focused on, this is the safety net that the federal government will pay if you're eligible for the age pension. And as we can see, what these current figures here are around just shy of $31,000 maximum age pension for a single person and about $46,000 for a couple. The reality is that in this current sort of financial environment that we find ourselves in, it is paying the bills, it is keeping the lights on, and there really probably isn't too much extra in the way of discretionary spending for leisure activities, for travel, that kind of thing. So probably not being able to hold private health insurance, and, very basic, eating out, maybe the RSL every few weeks for the senior special, that type of thing. So that is the age pension per the current figures. And then if we look to more of these ASFA standards, we have the modest retirement income or lifestyle. And that is typically a bit of a step up from the age pension in terms of there is a little bit more money for other needs and wants, but still quite basic. So ASFA are the Association of Superannuation Funds of Australia, and they do some really important work, really dealing with the self-funded retiree base and the superannuation space in Australia. And so these figures here, the ASFA retirement standard, are a quarterly survey that they conduct around retirees in Australia. And they're really asking them, what are you spending? What is your life costing you today? And so this is basically that national average budget. It does assume that you own your own home in retirement. So if you do not own your own home or you are still paying down your home, obviously your figures will be different. And it also assumes after-tax spending. So in today's dollars, so these figures here are as at July of this year, and ASFA do update these quarterly. So you can see how cost of living changes. It's effectively what does a certain standard of lifestyle in retirement cost in today's dollars. So it's really helpful from a planning point of view. So about $34,500 for a single person and just shy of $50,000 a year for a couple. So a little bit more than the age pension, which does give you, I suppose, some extra freedom, some, additional spending money for some leisure activities and a bit more of the fun elements of retirement, but it is not quite at that comfortable standard of living. So if we look at the comfortable figures, and really this is the gold standard, this is what ASFA, this is what what we would like our members to be on track to achieve from a spending point of view, because it means that you are paying all of your bills and you're able to do that comfortably. But you do also have money for private health insurance, for being able to travel. So there will be overseas travel budgeted for within the first sort of decade or so of retirement. There is money for eating out, playing rounds of golf, buying presents for the grandkids, that kind of thing. And in today's dollars, the July standard is about $53,000 a year for a single person and about $75,000 for a couple. So this is a guide. This may or may not feel or resonate with you, but it is, if you've not thought about it yet, this is a really good starting point. And of that standard, or of that, overall income that you are targeting, remembering that, it may come from a variety of sources. You may receive a part pension and then top up with super. You may have investments outside of super. So it's just thinking about, though, what number am I targeting? And then really unpacking what levers do you have to play with to satisfy this. Is it super? Are there other non-super sort of income streams or assets, pension, etc.? So bringing it all together. So we're thinking about at what age are we going to retire? How much are we going to need to pay ourselves, and where is that coming from? And then, of course, how long will we be retired for? So to put these pieces together and to see how you are tracking, some further helpful information that ASFA provide are essentially assuming that you retire at age 67, because that is in line with the age pension entitlement ages. This is the balance that is required for both singles and couples to be able to sustain either that modest income level that I talked about or the comfortable income level for your longevity. So a couple and a single person, both if they retire at age 67, doesn't matter if you're a single or a couple, but if you've got about $100,000 in super, if you own your own home, you've got $100,000 of super and then really no other substantial assets other than superannuation, because it is assuming that you're going to qualify for some significant age pension here. You really only need about $100,000 of super to be able to provide you with that modest income level for the remainder of your life expectancy. The reason being, pension, the age pension, is doing a lot of the heavy lifting. It's paying for the majority of your annual income requirements, and you're just drip feeding a little bit extra from your super to get you to that modest standard of living. On the same concept, for the comfortable lifestyle, it does require a higher super balance because, of course, you're enjoying or you're spending an income that is well exceeding the age pension. You're still drawing and qualifying for age pension with these assumptions at some point in retirement. There certainly would be part pension that is provided. And so for a single person, you would need about $595,000 of super upon retirement at age 67, and a couple would need about $690,000 combined, because pension and then top-ups from super are going to provide you with that comfortable standard of living for your statistical life expectancy. Now, that's all very well and good if you retire at age 67 and you fit that nice little criteria that I talked about in the assumptions. But if you want to retire earlier or spend a different amount, or you are worried about longevity and living longer than the statistical average, then your numbers will be different. So how can you actually try and figure this out for yourself and work out a plan to help you achieve it? Well, this is where we can explore some of the excellent tools and resources that we have available on the Australian Retirement Trust website. And this is where we're starting to look at our projection calculators, our retirement projection calculators. So we're going to meet this case study here of this couple, and they are currently 58 and 60 years of age, and they're earning a total combined income of $120,000 a year. Total super balance between the two of them at their current age of about $100,000. And they want to aim for that comfortable lifestyle standard, circa sort of early to mid $70,000 as a couple when they retire. And they are intending to retire at age 67 in line with their age pension entitlement age. Okay, so they really want to achieve about $73,000 from age 67. So they've got a little bit of time to really come up with a plan and get them on track to achieve that. So using the calculator here, it's very intuitive, very easy to follow. You're obviously starting with your current details, your age, your balance, your income, your super contribution rate. So really encourage you to play around with it. Now, with tonight's webinar, we know that, as Australian Retirement Trust, we look after the superannuation of almost 2.4 million members throughout Australia that work for a wide variety of employers, including a lot of corporate arrangements and corporate plans. And so different employers may have different employer superannuation arrangements outside of the legislated minimum superannuation guarantee of 12%. So where relevant, if you are working for an employer such as Queensland Government, for example, that may have different employer arrangements, we would encourage you to utilise the more specialised tools that are dedicated to those specific employer arrangements. Whereas this one here is really designed to be, I guess, a bit more generic for that general public, where they're typically only receiving what's known as superannuation guarantee employment arrangements. But for this particular couple, remember they're currently 58 and 60 years of age, looking to retire at age 67. Let's see how they are actually tracking towards that income goal of just shy of $73,000 a year. Now, in this instance, remember one person is slightly older, so they will reach age pension age first. So for the next 2 years, the younger person will still continue to be working. And so employment income is still being received and is covering a chunk of that overall spending. There will be some drawdown from superannuation, as well as a small amount of age pension at that point, because of course there is still earned income from the younger member of the couple. In 2 years' time, when they're both at age 67 and they're both retired from the workforce, you will notice more is coming from the age pension, which is indicative of that navy blue line, and the remainder is being topped up by superannuation. So they're able to receive that $73,000-ish total income coming from age pension and super. But at around age 77, the super is exhausted. They've spent all of their superannuation. And so from that moment on, they are really just relying on the age pension, and they will no longer be able to draw down that comfortable standard of living. So this is a really good illustration of, if I do nothing, if I just go with the status quo, this is how I'm tracking and what my retirement is looking like. The beauty about these calculators and the beauty about you joining these webinars earlier in your career, when you still have time to set strategies and make a difference, is you can go back to those calculators and review and make changes and see the impact that these changes can have on your retirement. So we've now got time, whilst we're still working and in being employed and contributing, we've got time to really bridge that gap and, to make a difference so that we can be on track for the lifestyle that we are looking forward to. So that is really, I guess, the building blocks of the planning element. Really start thinking about, those numbers and those goals. When do I want to retire? How much am I going to need? How am I tracking? And now to really talk us through, well, in retirement, the whole purpose of superannuation is to use it to provide this income, and we've already talked about that as a concept. Really, what are the building blocks that we have available at that stage? So I'll hand it back to Josh to take us through that next phase.
Thank you, Megan, and it is nice to be back behind the desk. We've had a number of questions already coming in too that I'll very quickly knock off. Is a copy of tonight's presentation will be provided to you in coming days. So I'm sure many of you are taking notes or wanting to watch back on things we're covering. Please be aware you will receive a copy of the recording and able to watch that back at your leisure. The second question was in regard to some of those figures that Megan showed, that we're saying the amounts that ASFA suggests you should have saved to live that modest or comfortable retirement. Those figures for a couple, for example, are actually showing the combined balances for that couple, not showing what you would need as an individual in that case. But what I'd like to do now is go into a bit more detail, as Megan just outlined, that now you've worked out where your income is going to be needed and how much you need, that let's talk about how much those sources of income that will provide that for you. So as Megan's outlined in that projection, a lot of your income will come from the age pension, but you'll also have other sources coming to you, including superannuation and also your own savings outside of that. So I think what we're seeing is that for many of us traditionally, our retirement would be funded largely by the age pension. But now we're seeing that the age pension is actually going to be something that is just supplementing other sources. So you've got your own income from other sources. You've also got your super becoming a more dominant part of your retirement savings and your retirement spending. And as I said, the age pension, which is still going to be a very big part of most people's retirement, is something that you will have less and less dependence on as our superannuation system continues to mature. But let me put it to you that what we're talking about tonight is that your retirement, as we've described, will be unique to you and your situation. That means the sources for you in your retirement will also be unique to you and your situation. There might be some years that you're receiving the age pension and some years that you're not. Some years that age pension is ebbing and flowing as you might see employment income coming in and out. What we now tend to see is that a retirement is no longer just a day in the line, no longer a line that is just set. Your retirement is something that you may go into, come out of, and re-enter a number of times. So you might see employment income coming in and out at the same time that you're seeing those ebbs and flows in the other areas that I've outlined. So let's just think about that first one that I discussed, the age pension. The age pension has been a key part of Australia's retirement system for well over the last century. And it will continue to be part of Australia's retirement income needs. We currently have about 80% of Australians over the age of 67 who receive some form of age pension to supplement their income in retirement. So when you turn the age of 67, you'll go to the government and seek to get the age pension from them. And they will actually pass you through two means tests. You'll actually have an income test and an assets test that will be applied to you. Now, with those income tests and assets tests, and Megan actually referred to this a little bit earlier, that we'll cover this in much more detail in session 3, the government will basically look at everything you own and everything that you earn. And from that, they will determine whether you have enough, either in assets or in income, to fund yourself. As a result of those two tests, the government will actually take whichever result is the harshest upon you, and that will determine the age pension that you will receive. Now, again, if I can reiterate, this means that as your circumstances change during your retirement, you may go in and out of employment, you might be spending down savings, you might be receiving inheritance. As you see those ebbs and flows, you should expect that your age pension too may ebb and flow. There may be times that you receive a full age pension, times you receive a part pension, or possibly times where you receive no age pension at all. But the age pension will always be there as a safety net if and when you need it. The second key component of your retirement income, particularly if you find that you do not pass those tests and so you're going to be reliant on your own personal savings, is your superannuation. And it's concerning that about 1 in 3 Australians actually say that they don't have a strong understanding of their superannuation. So just to give you a really quick 101 on your super. Many of you who are joining us tonight may have what's called a defined benefit. And a defined benefit account is going to be something that you have particularly if you are much older and you joined the workforce and had access to superannuation benefits very much largely prior to the 1980s. A defined benefit is going to give you a calculated superannuation amount at retirement. What I mean by that is you don't have an amount that is invested that ebbs and flows based on markets and based on contributions. Instead, you're going to have your superannuation balance determined based on a calculated formula. That formula will be largely based on your salary and your years of employment. The wonderful thing about a defined benefit is it gives you certainty. You know exactly how much you will receive in retirement. If I can think about the disadvantages though, it means that you don't have the ability to invest it to make windfall when markets are performing strongly. but conversely, it protects you when markets are volatile or when they may fall. For the vast majority of Australians, though, certainly those who have joined employment since really the 1990s, for the majority of us, our superannuation is going to be in what's called an accumulation account. An accumulation account simply works like a bank account. Contributions go in, fees and taxes come off, and investment earnings are also applied. It will then, at the point of retirement, give you a final balance determined based on all the additions and subtractions of those transactions. It will ebb and flow with investment markets, and we're going to spend a considerable amount of time next week talking about that investment journey and some of the considerations. Now, at the basis of superannuation for all of us is the money that is paid into our account where we have gainful employment. Historically, this was actually as low as 3%, but it has gradually increased to the level of 12%, which it reached this year. So your employer, where you're gainfully employed, is required to put equivalent of 12% of your salary into super, effectively deferring income until your retirement. As Megan said, we have a lot of people joining us from a range of different employers around Australia, and you may actually find in your situation and circumstances, your employer pays you more than that 12%. But generally, for the broader population, this is the basis of your super. Megan will also talk about, though, how you can think about adding more yourself to that. So what will then happen with your super is it will go through a journey throughout your life. It starts with accumulation while you're working, while you're saving, of having that money going in from your employer and contributions that you are putting in yourself. There will be a point, though, that while you're working, you can start to access your super. And currently, that's at the age of 60. That regardless of your employment status, you can start to think about taking income or withdrawals from super, and we'll talk more about this actually in session 3. But we can help you in that transition stage as you move towards permanent retirement and start to think about how you'll use your super at that time. Will you withdraw it all as cash? Will you withdraw small lump sums? Will you take it as an income stream? Or will you do bits of all of those? That is what we're going to explore throughout this series, and we'll actually focus on it quite intently in the 3rd session. Before I do hand back to Megan, and actually we'll cover off some of the questions that we've had coming in so far this evening, I'd just like to talk a little more about some of those points of access of when you can start taking out your money from super. So as I've already mentioned, at the age of 60, generally you can start withdrawing money from your super, but the way in which you can withdraw that is going to be dependent on your work status. If you are still employed at the age of 60, you cannot start to access your super, but you are restricted to what's called a transition to retirement income account. And this is where you're permitted to take up to 10% of your account balance each year in income. It means that while you're still working, you might see that you're wanting to step back from your career a little bit, perhaps going part-time. You might change roles into something less stressful. Your physical health might actually mean that you want to scale back in the work that you do. In any of those situations, you can start to access your super in this way. If, though, over the age of 60, you decide to permanently retire, then you can actually commence a full retirement income account, or you can start to access your superannuation. The other consideration is, though, that at the age of 65, once you have your 65th birthday, regardless of your employment situation, regardless of what you're choosing to do with work, you now have full access to your super to do with what you want. So remember, from the age of 60, the way you can access your super is determined based on your employment. From the age of 65, it doesn't matter what your employment status is. You can start to access your super. Now, if you don't have enough, you have two choices. And Megan's already alluded to this. And this is what we're going to, you've got a number of choices, which Megan has alluded to prior to now. The first is that you can think about reassessing your retirement goals. How much is it that you actually thought you needed in retirement? And if you find you're not going to have enough to get there, you might have to scale that back. You might have to bring those goals down a bit. You might have to think about your income needs and actually scrutinise those a bit further. Is there a way that you can budget a bit more tightly? Is there a way that you can bring those numbers back for your situation? Or perhaps you need to think about your retirement age. Should you be retiring a bit later than perhaps you planned? So if you don't have enough, these are some things that you can reassess. But the two things that you can really change or make an impact on, particularly if you're some distance out still from retirement, is in regard to your savings. What can you do specifically in relation to your superannuation to improve your retirement position? And that's what we're going to talk to both for the rest of this evening, but also the coming weeks. There are two things you can do. You can either think about making additional contributions to your superannuation. You can also think about doing some house cleaning with your super to bring any multiple accounts you have together, which Megan will talk to shortly. Or you can think about the way you're invested and making some changes there. But before we unpack this, Megan, let's just take a moment to reflect on some of the questions that we've had coming in, and then I'll get you to do a deep dive, if that's okay, on those contribution options that we have.
Sounds great, Josh. Now, I promise I'm not being rude looking at my phone. This is where the questions are coming through. So there are a couple that relate to the topic that we've just talked about. And one is around access to super. So can you draw down a lump sum to pay your mortgage off once you commence retirement before moving the rest of your super into, another option? And the answer is yes, absolutely. So once you reach a condition of release, you've got a lot of flexibility with how you structure and how you take your retirement savings or how you spend it. And this is something that will be explored in a lot more detail in our third session, which is how to pay yourself in retirement. But the answer is yes. On a similar note, if you are retiring, if you have a defined benefit account, how do you notify ART that you've retired and you want to access your super? Well, there will be relevant claim forms. So we will be notified by your employer of your finishing your employment, but also then there'll be claim forms for you to tell us what that you want to do. So just give us a call a little shortly before your retirement and we'll walk you through the relevant process at that point in time. Some information or some questions just wanting more information about that ASFA retirement standard that I was talking about. So there is information in your workbooks on page 7, but also ASFA. So if you Google ASFA or superguru.net.au, I believe is their website, but there'll be links in the workbook as well.
And I might cover one and then we'll cross
absolutely.
to you for contributions, if that's okay,
Sounds
Megan.
great.
But we've had a question coming in around with transition to retirement, and it's how long can you stay in that TTR account, and is that subject to tax? So when it comes to a TTR, once you turn 60, any income that you're withdrawing from super is tax-free income. The difference with the TTR compared to a full retirement account, and this is something that we will cover off in more detail, but when it comes to a TTR account, the investment earnings that you make on that TTR account are taxed at up to 15%. Once you permanently retire, once you cease to have a TTR and have a full retirement income account, not only is the income you receive tax-free, or any withdrawals you receive tax-free, but also the investment earnings on that are tax-free. So the key key differences between a TTR and a full retirement income account is the TTR, you can't take more than 10% of your balance a year. Investment earnings are taxed, whereas with a retirement income account, you can take any amount out of that and the investment earnings are tax-free. We will, as we've outlined, discuss that more though in a future session, in session 3. But Megan, what we'll do at this point is go back to you to think about and talk about contributions.
Yeah, thank you very much. So this is really the concept. And this is the beauty that we have at this stage of our life while we are still working. We've really got these opportunities to grow and boost our super and to really awaken our super and get it growing as much as we possibly can. So first and foremost, get connected with your super. Your super is your money. And I know sometimes we don't like to think of it as that because it's retirement, and retirement's, for the future, but it is your money. So register for your online access, download the app, make sure you've got your log-on details and you've got your multi-factor authentication set up as part of that to give that extra layer of security to your account. And check your balance, read your statements, use the calculators, ask questions and learn more. So get connected with your money. And then, while you're at it, this concept of potentially, and, certainly a lot of us, whilst I've been at art now for 14 years, prior to that, I did what any young person did, and I worked multiple jobs and collected super funds with every new employer that I went to. So when I first started with Q Super 14 years ago, I did consolidate all of my super and I got it all under the one roof because for me, I could see that benefit. It was a very laborious process back then because you had to get certified photo ID and fill out a paper form for each fund that you wanted to consolidate. These days, by and large, the process is a lot simpler and can be done for the most part through your ATO MyGov portal or through your online account. And generally speaking, having all your super under the one roof can be beneficial because it simplifies things. There's less paperwork, less funds to deal with. It can minimize investment fees and also insurance premiums. But there are some considerations to look into because there could be things like loss of insurance benefits or exit fees or taxes. So do your homework. But if you do ultimately decide that you would rather it all under the one roof, that process is generally quite a lot simpler than it used to be. Caveat being, the super fund names do need to match. So unfortunately, if it is a maiden name, married name scenario, the names do need to be updated before that automatic sort of consolidation process via the ATO records can take place. But, get engaged with your super, consolidate, get it all under the one roof, and then obviously now explore your ways to contribute and grow to super. And we are going to keep this high level this evening, and this will absolutely be explored, including some case studies next Wednesday in the How to Grow Your Super session. But the reality is that there are two methods that we can add to super. There is what's known as the before tax or concessional contributions and the after tax or non-concessional contributions. And generally it is the concessional contributions that people want to make the most advantage of because, one of the whole benefits of super or one of the key tenets of superannuation is that this money is generally locked away until we retire, but the trade-off is a much lower rate, lower taxed environment, hence the term concessionally tax. That's just a fancy way of saying a lower rate of tax. So concessional tax for the most part is a tax of only 15% versus your marginal rate of tax on the income that you earn, which is for the most part going to be considerably higher than that 15% concessional rate. So the annual concessional cap, and these are all financial year, is currently $30,000 in total. Now, what counts towards this concessional cap? Every single dollar of employer contributions that your employer has to pay you counts towards your concessional cap. Anything that you personally choose to either salary sacrifice into superannuation or where you're claiming a tax deduction, because ultimately these monies are only being taxed at 15% upon entry to the super fund, whereas if they had not entered via this method, they would have been taxed at your marginal tax rate. So $30,000 is the financial year limit. For some of us, we may have the capacity to contribute a bit more than that if we haven't maxed out this limit in previous financial years. We will talk about this strategy next week in the How to Grow Your Superannuation session. But a really key thing to note here is that your employer contributions count. And so particularly if you are working for an employer where they pay higher than the minimum employer super, which is currently 12%, that's the superannuation guarantee. So if your employer is paying an amount above that, you need to understand that that counts towards that $30,000 concessional cap. So they're your before tax, your concessional contributions. On the other hand, money that you have already paid your pound of flesh via your marginal tax rates to the ATO, you can still add that to super yourself, and this is known as a non-concessional or an after-tax contribution. And because you've already paid your full rate of tax, that annual limit is a lot higher. It is actually $120,000 per financial year. So any of your voluntary contributions that you put in after tax, potentially spouse contributions, if that's a strategy that you're utilising, they will count towards this non-concessional limit. And there can be benefits for doing this depending on your income and the income of your spouse. They might qualify you for things like the federal government co-contribution or also spouse tax offsets where there is a lower income earning member of a couple. And again, those concepts will be illustrated in more detail in next week's How to Grow Your Superannuation webinar. Now, the non-concessional limit is $120,000 per financial year. It's not uncommon, particularly as we get closer to retirement. We might find ourselves in this situation where we've got some non-super assets that we want to bring into the super environment, potentially maybe the sale of an investment property or an inheritance. So there is the capacity until the age of 75 to utilise what's known as the bring forward rule, which could potentially allow you to put in up to 3 years of after-tax contributions in one hit, and you wouldn't be able to make further contributions for the remaining 3 financial years. So whilst the single limit is $120,000, if you're wanting to put in a bit more than that, you may be able to put in up to $360,000. And again, we'll talk about that next week. So last but not least, there is also an additional type of contribution, and this is relatively new. It's known as the downsizer contribution, and really this is making reference to the fact that, you know, it might be that you are living in the large family home and your adult children have, you know, flown the coop. They've gone and established families and bought houses of their own. So you might look to sell that bigger property, downsize. Obviously, the sale of that property might give you, you know, additional cash flow or funds that you would like to add into superannuation. So this is distinct from those other contribution limits that we mentioned. There are, you know, eligibility criteria. It does need to be your principal place of residence and qualify for that. You do need to have owned it for 10 years, but it is going to allow you to put in up to $300,000 each. So if you're part of a couple, potentially $600,000. As an additional contribution, and it's not subject to the normal non-concessional contribution cap. So, but only when it is the sale of effectively the principal place of residence, and it's got to be over the age of 55. And there are limits in terms of timeframes, how quickly that money has to be added to super after the settlement of the property. So, you know, that's effectively the rules or the methods to add to super and the limits that are attached to it. What is right for you and the best strategy? Well, you can certainly learn more about it on our website, and page 14 in particular in that workbook will dive into that in more detail. But if this has really whetted your appetite and you would like to explore this concept in greater detail, we would strongly recommend that you register and attend next Wednesday's session. So same time, same place, next Wednesday, How to Grow Your Retirement Savings. So that is a really quick look at contributions into super. We will talk about the next really important piece of the puzzle, investment, shortly. But Josh, have we got any questions
Well,
at this point?
There is, but before the questions, I think we should make an acknowledgement. You and I are having a lot of fun noting which camera to look at.
It is a bit of a new environment for us tonight.
I think it's actually, it's a bit of a choose your own adventure for the people at home.
Yes.
So, we're just, we're going with the flow, guys. So thank you for putting up with that. There are a few questions coming in, but if I can be really honest, a lot of those will be covered off in the webinar next week. So I encourage people to come along for that. But Megan, one question I do think is pertinent, especially because we've had the announcements from the government this week around a couple of things. I think it maybe was missed in the headlines, but there was an announcement regarding what's called a low income super offset.
Super tax offset, LISTO.
Yes, LISTO. It's in relation to contributions. Can you just give context of what it is? And maybe it's something we'll also look to explore more next week.
Absolutely. And it is actually a really exciting, we're super junkies in case you haven't figured it out. So we get excited by policy changes and it is probably something that is overdue. But effectively, LISTO, the low income superannuation tax offset, is really, it's an equality measure and it's designed to really provide access to lower income earning Australians. And it's a reflection of the fact that with the employer contributions, they are subject to the 15% concessional tax. Now, for most Australians, particularly middle to high income earners, the average wage earning Australian will be paying an income tax rate that is significantly higher than that 15% concessional rate. But for lower income earners, their marginal tax rate is only marginally higher, and in some cases actually now going to be less than that concessional tax. And so the LISTO is refunding the contributions tax that is deducted when that employer contribution is received as a bit of an equality measure. So it is something that has not actually changed since 2012. And so the exciting news this week is that from 1st of July 2027, there will be changes where it's basically increasing the income threshold, so more Australians will be eligible, and it is reflective of the fact that employer super, that SG superannuation guarantee, has risen from 9 to 12% in that last 10 or so years. So really important changes, and I think the stats are now that 1.4 million of the lowest paid workers in Australia will now qualify under this new scheme. It's going to give them a real boost to their superannuation savings. I think, and women predominantly, because 60% of the lowest paid workers in Australia are women. And I think modelling, because ART has been very vocal in this change, I think modelling suggests that about 250,000 of our members will benefit from this very real policy change. So that's my little super soapbox for the evening.
It is a wonderful announcement, and I think in the scheme of announcements that have been made by the government this week, it's a very important one, and as Megan said, one we've been championing for. A number of questions have come through around contributions. If we have time at the end, we'll cover some of those off. But
and
again,
shout out though to our colleagues in the background that are responding to a lot of those questions.
Absolutely,
right now.
Working very, very hard. But we will cover those off if we have time at the end, but also encourage you to attend that session next week. The last key piece that we want to provide a highlight to, which we'll cover in a lot more detail in the weeks that follow, but the last key piece we want to provide a highlight to tonight is in regard to investments. So contributions can certainly go a long way in making a big impact to your superannuation, but the reality is the bulk of what you actually have in your super account balance at the point you retire is actually going to be made up of investment growth. And it's important that when you consider your investments in your super, that you think about a number of different things. Firstly, the time that you have available to invest. I think for most of us, we think about our investments and what we're doing with our money in very short-term concepts. We think about what we want to make over the coming months or year, or perhaps even over the coming years or decade. But When it comes to your superannuation, you have the ability to think about what is your super going to do over many decades. If I think about, in my case, I started my superannuation journey in 1994. I've been in a superannuation account now for about 30 years, but it is very likely I will have another 40 or even perhaps closer to 50 years of that superannuation working for me. So I should be thinking about my time as being really over that 80-year period or more. The second thing to consider, and we'll explore this a lot throughout this program, is the volatility that comes with investing, but also the volatility that comes with the choices and the expectations that we have around our investments. And what I mean by that is that we each have different appetites or different concerns when it comes to investments and in regard to volatility. Some of us may be more conservative than others. But you have to then balance that out with the fact that you might have a desire for very high investment returns. And to be blunt, high investment returns only come with risk. There is a reward that comes with taking that risk. And so you have to think about that volatility and the volatility that you are prepared to experience and that you are actually comfortable with in driving those rewards. The other thing, though, is how much involvement do you want when it comes to your investments in your super? More than 90% of people with superannuation accounts do not make an investment choice. Less than 10% of superannuation members, not just with Australian Retirement Trust, but generally, less than 10% of superannuation members have made an active decision in regard to how they want their money invested. And that's fine. We as a fund are very much set up to look after those members who have not made an investment choice. But for those of you who are engaged in your investments, for those of you who are engaged in wanting to make an investment choice, you have to consider how much involvement that you want in that regard. So just to go through some investment fundamentals that we'll continue to deep dive and explore in the weeks that follow. But the first is in regard to what I was talking about a moment ago in regard to that risk-return trade-off. And it's really understanding that superannuation funds invest in a whole range of different assets. Those assets come with different risk profiles and different return opportunities. And as I said, generally speaking, you should consider that for a higher return, you are going to need to take more risk. And as a result, you will have higher volatility in those assets. So as a superannuation fund, what we're actually trying to achieve for you, where you don't make an investment choice, is how do we actually diversify across all of these assets, but also have a balance across them? How do we make sure that we're giving you exposure to growth, but also protecting you with some of those more conservative assets? And as I said, this is something we will explore in much more detail. So you'll hear us over the coming weeks talking about a whole range of different underlying assets that we invest in on your behalf. This includes shares that most super funds do invest in, certainly have invested in traditionally, and where typically, unless you have made an investment choice, typically you would see about half of your money invested. And this is both international equities as well as domestically. What we know though about shares is that although they give wonderful growth potential over the long term, they do come with short-term volatility. We also know that it's quite limited in what we can invest in, that we are limited to those companies that are listed on the stock market, a point I'll come back to in one moment. So superannuation funds have traditionally tried to offset some of this volatility, tried to offset some of that uncertainty that those investments can bring for members by also investing in traditional income assets, things like cash as well as fixed interest. But the reality with things like cash and fixed interest, certainly over recent years, certainly since COVID, is that they do not provide the investment returns that our members want and expect. In many cases, investing in things like bonds, for example, means that you've almost been earning less than the inflation rate. You've almost been coming out negative when you look at a real return perspective. So it's very important as a result of thinking about those traditional assets in shares and cash that we look at how we can diversify you further to actually get access to some of those features. And that is why, as a very large superannuation fund, we have the ability to diversify you and invest you in other areas that you yourself couldn't get alone, such as through a self-managed super fund, for example. This includes in investing you in infrastructure, roads, rail, airports, but it's also in thinking about new and emerging technologies, renewable infrastructure, renewable energy infrastructure, data warehousing, other infrastructure projects of the new age that really give us incredible growth and capital income capability. We also invest in property, not just one property, not just a dozen, but hundreds of properties around Australia and globally, including residential, commercial, as well as thinking about industrial property, diversifying you across a broad range of different investments in that asset class. And we also invest you in what we call private equity or private capital. These are large global companies, in many cases, that are not listed on the share market. These are privately owned assets that give us incredible growth potential as well as give us great income. We'll provide some examples of these in coming weeks. But know where you have not made an investment choice, we diversify you across all of these areas. But you may choose through investment choice to concentrate on a few of these or some of them in particular. How you choose to do that is really going to be based on how much engagement, how much involvement with your investments you want to take. For those of you, remembering this is about 90% of members who don't want to make an investment choice, you will typically be invested in a fund's default investment offer, also referred to as a MySuper investment. In our case here at ART, it is referred to as our life cycle or lifetime investment. It is an investment where we determine the underlying mix of all those assets I talked about. We determine that based largely on your age and your stage in life. And as I said, we'll explore that more in coming weeks. If, though, you want to be a bit more active, you want to make some choice around your investments, but perhaps you're unsure as to where you really want to deep dive, or perhaps you want to make sure that you've still got some really good diversification. We have what's called our diversified investment options. And these are options that the name tends to suggest what we're investing in on your behalf. A conservative option, for example, will invest more in some of those conservative assets, income, cash, fixed income bonds, for example. If you see something like a high growth name, then you know it's going to be exposed to more things like shares, for example. Or if it's given a name like balanced, you know it's actually going to be a mix of all of those. So the name usually gives a descriptor as to where that tends to lean. But if you are like me and someone who wants to take a much stronger engagement with their investments, then you have the ability to select from what's called our single asset classes. And these asset classes is where, for example, you might decide that you want to have a specific percentage of your balance in property, for example, or in cash, or in one of those other asset areas that I talked about. When it comes to Australian Retirement Trust, you have 16 investment options you can choose from across all of these. You can choose and mix them in any way that you want and choose as many as you'd like. And you can make those choices very easily at any time, including through the mobile app, online, or by giving us a call. So just to demonstrate what I was talking about around those diversified options, what I'm showing here is from one end of the scale to the other. So really giving you the extremes of those diversified exposures. On the left-hand side, you've got the high growth option, which is showing in those colours that there's a very strong allocation to those areas like equities, property, private capital, for example, but has a much lower exposure to things like cash and fixed interest. On the other extreme, you're seeing that that exposure or those scales are actually flipped. We encourage you to, between now and next week, if it's of interest, to really explore the information on our website and to think about how you might want to invest, or even just to check in on how you're invested now and if you're comfortable with that. Gain some understanding of what we're doing with those investments and what investment choice you may or may not wish to make. Now, as I said, your superannuation is a long game investment. This is something that you shouldn't be thinking about in terms of what it's done in the last month or last quarter or last year, but instead you think about the potential that it has over many decades. And so if I put it in terms of those diversified options that I've just outlined, and this is something I will pick up on next week, what would your journey have been if you were invested in one option over another? And what I'm showing here is how your investments would have been if you had an initial $10,000 investment, you made no additional contribution to that, and it was invested in our high growth option. That today would be worth close to $70,000. That initial $10,000 investment has had incredible investment growth. Remembering I said earlier that when it comes to your superannuation, most of your balance at the point of retirement will not be through contributions, it will be through the investment earnings that you had upon those contributions. But as I go down the scale, you would see that as the exposure to those growth assets diminishes, you also see the return potential diminish. And although that you see that return potential diminish, you have to acknowledge that for many of our members, they want to be able to sleep better at night. They don't want to be concerned about volatility. They don't want to be concerned about loss. They want to make sure that their money or their balance, although still diversified, is more secure. And this is where you have to think about the risk you're willing to take, the appetite you have for risk, but balancing that off with the expectations you have for investment earnings. Any investment earning that is promised, that is grandiose and bold, if it is being promised to you without risk, it's probably something that you shouldn't invest in. It's probably something you should be wary of or really be uncertain about. Any investment that is promising you great return, particularly if it's coming from a strong performing investment house, is one that you should acknowledge will come with some level of risk to achieve that return outcome. But as you can see here, the rewards for that risk are high. What we'll talk about next week is that what we're wanting to achieve across any of these investments for you is a return that is stronger than inflation, stronger than cost of living, to make sure that the real return you are earning can contribute towards and well into your retirement. So if we think about that plan that Megan talked about earlier, that case study, what would have happened in that case if we saw additional contributions made and a slight adjustment made in investment outcome? What we'll see in this case is that desired income each year has been achieved. It's still largely reliant on the age pension, but it is now a lot more based on other areas, including superannuation, including your employment income in those early years. It is giving you additional freedom above the age pension. And this is really what we want for all of you. It means that in retirement, you're not just paying for those needs that you have, but also paying for those wants that you want to enjoy and experience through retirement. We encourage you to explore, much like Megan has outlined with the contributions, also explore our investments. And we'll come back to talk to you about all of this next week. Now, I am conscious of time, so before we go to a final ad break and before we go to final Q&A, Megan, do you just want to bring us home on a few housekeeping things or things to consider? And then we'll start to wrap things up.
Yes, thank you, Josh. So, this evening is really a bit of a high-level overview in terms of what to start thinking about your planning, and there have been many, many questions about contributions. So we would encourage you to seek some, further guidance and assistance there. But really, in terms of it is just about awakening your super and learning about the opportunities that you have to maximise things. So use the retirement calculator, and remember, if you do work for a specific employer with unique employment contribution arrangements, there may be a special calculator designed for that. So check that out on your work website. Potentially look at combining other super accounts as we've talked about. But this concept of making extra contributions, many, many questions have come through wanting more detail. So next session we'll look at that. And in terms of how much you can contribute, what's the best way, what's the most effective way, how much do I need to contribute to get me to where I want to be, this could be part of an advice strategy. Investments are also incredibly important and topical, as Josh has mentioned, and we are able to provide you with advice about the most appropriate investment mix of your ART account that's included as part of your membership. So more information about these details in page 11 of your workbook. Now, I have mentioned advice, and certainly advice is provided as part of your membership with ART about all elements of your ART account, including your contributions and your investments. But if you've got a relationship with your own external financial advisor already and you're comfortable and you trust that relationship that you have with them, then we would encourage you to seek that guidance and that support from them. But we do have a program to really work with external advisors and give them the support and the tools that they need so that they can advise their clients appropriately. So we do have dedicated advisor support. So mention that to your advisor if they're not aware of that already. But yes, a lot of further guidance and opportunities for you. So work through the workbook, look at the tools and calculators, listen to the podcasts, attend the other sessions with the different topics that we've already outlined. And if you're not quite sure if this is really, and these sessions are almost deliberately designed to really probably pose more questions than they necessarily answer, at least immediately, we are there to support you through those next steps, and advice might be one of those next steps. So, jump on the website and search advice, and we'll be able to look at booking you an appointment to do that. So that's really the end of this session. Just a little bit more housekeeping. Remember, the recordings are coming out in the coming days, and we really do welcome your feedback, and we use that to guide future improvements to our program. So keep an eye on your inbox, not only for the recording, but there will also be a survey that we kindly ask you to take a few moments of your time to provide you with that feedback. So with that being said, we have a little bit more time for questions.
Well, before we go to questions, let's just cut to one more quick commercial. And if you've got any questions that you'd like answered tonight, probably your last chance to pop those in, and we'll be back with you.
Quickly review those.
We'll be back with you in about 30 seconds.
It's time to wake up and take a look at your super. You could be sitting on a monster. With the latest Australian Retirement Trust app, managing your super is easy. Check your balance, control your contributions, and track how you're invested, all in just a few taps wherever you are. Plus, get notifications and handy tips. Download the new and improved Australian Retirement Trust app today to find out if you're sitting on a monster. Get it now on the App Store and Google Play and see what your super's been up to.
All right. So in thinking about some of those last questions we've had, Megan, and we might just go over a few different areas that we've been discussing tonight. First question I'd like to ask you, maybe pulling everything together. If I've already retired, can I add more to my super, or what do I maybe need to think about?
Yes, asterisk, because there are age limits, there are contribution limits. So anyone can freely contribute to superannuation, to their accumulation account, to the age of 75 without needing to be employment. From 75 onwards, you can't make any further personal contributions. But depending on the size of your account balance, there may be some further restrictions as well. But generally, yes, you can contribute to super up to the age of 75. If you're not employed, they're likely to be non-concessional or after-tax contributions. So, of course, that annual limit is $120,000 per financial year.
Wonderful. If you are making contributions, and this is maybe a bit of a each way bet answer, I think, but if you're making contributions, what are the pros and cons of claiming a tax deduction while still employed?
Yeah. So ultimately it comes down to, the concept of those tax concessions. So generally, you're either salary sacrificing those contributions, as a salary sacrifice arrangement, which means you're benefiting from that reduced tax rate immediately in your paycheck every payday. Or alternatively, if you're putting in after-tax contributions throughout the financial year, if you've not salary sacrificed them, and if it is in your best interest to do so, you can go back and claim a tax deduction at the end of the financial year, which is a manual process, but ultimately what it does is it treats those contributions the same way as if they had been salary sacrificed in the first place, which is it taxes them at a lower rate and it makes it a deduction on your tax return, increasing your tax return. So basically, long story short, you are benefiting from that reduced taxation treatment of personal contributions into super as opposed to your marginal tax rate. So whether or not it's right for you, well, it depends on how much are you contributing already, what's your tax rate. So potentially some advice would be really warranted in that respect. And of course, next week's, I've said this a dozen times already, I sound like a little bit of a robot, but the How to Grow session will give a lot more detail to those.
And the other thing is, remember as well, on our website, we've got the contributions calculator as well as a lot of information there that allows you to explore what might be the right way for you to contribute and what could actually be the tax advantages or other opportunities for you to consider around making contributions. We've also had a number of questions come in regarding withdrawing in retirement. We've had a number around the theme of, well, what are the disadvantages of me withdrawing my money from the super system at retirement? Well, the main disadvantage is that, remember, your money within superannuation is tax-free over the age of 60 with any withdrawals you take, any income you receive, but also if you have it in a retirement income account, it's tax-free investment earnings. If you were to withdraw all that money outside of the super system, you're basically closing off any of those tax advantages. Any money that you have outside of super are going to be taxed in some way. So that's the main thing. To Megan's earlier point as well, once you take that money out of the super system, it actually becomes more difficult to put back in or contribute in. So there's a lot there that we probably need to unpack, but there are certainly disadvantages. There was then also a question around, well, is there any advantage in commencing a transition to retirement income account that will provide me an income in retirement if I don't actually need the income? And there are a number of advantages. And again, those are probably something that I'd encourage you to come along to session 3. We'll explore in a lot more detail. But at a high level, if you've got a transition to retirement income account, what you can actually use throughout. If you don't need that income, you can be having that income come to you and you recontribute it back into your own account, and you actually effectively change the tax status of that. That actually means that in the event of your passing, it just improves the tax treatment of those benefits if they go to a tax dependent. So something we'll definitely cover in session 3. There's a lot of detail and a lot that you need to be considering regarding that. But the other reason you might want to do it is if you're part of a couple and one of you has a really big balance, or one of you is retiring sooner than the other, a couple of other circumstances, it might actually be advantageous to have a transition to retirement income account, paying that income out, and you actually pay it to contribute it into your partner's superannuation account. So a couple of benefits there that again we'll explore. So we know that tonight has had a lot of information. We know that tonight we've also, as I've been mentioning, we've juggled a new studio setup. So apologies for us not looking at the right camera or losing track a little bit. Trust me, we learn from these experiences. But I would like to thank Megan for being with me tonight to help me guide you through this session. I would like to also thank the wonderful team that we've had working in the background, answering all your questions, as well as the team we've got in the studio here that are helping us bring this event to air. We look very much forward to seeing you next week for what's going to be a very big session where we'll focus on contributions and investments and talk a lot more about the economy, and also thinking about some of the investment considerations around current volatility. With that, have a very good night, have a very good end to the week, and we'll see you again soon.
Thank you.